Well, U.S. jobs data headlines are positive. The numbers are actually a negative for the U.S. economy. That is according to our next guest. So how does this data impact his investment strategy? Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital, joins us now from Connecticut. Peter, great to have you with us today because I do think that the market's really trying to figure out how to interpret this data correctly. Give me your negative call on it.
I think it's pretty straightforward once you get beneath the headlines. Yes, we created 195,000 new jobs, but they're part-time jobs. More than 300,000 Americans are working part-time now as opposed to the prior month. So we have fewer Americans working full-time in June than in May. That is not good news. In fact, the U6 unemployment rate jumped up by 0.5% to 14.2. That is a huge jump. We lost another 6,000 manufacturing jobs. That's the fourth month in a row where we've lost manufacturing jobs. You know where all the big job gains are? It's in leisure and hospitality. We have more people in America now working in bars and restaurants than ever before. These are not good jobs. They are low-paying part-time jobs, and you cannot build an economy on these types of jobs.
So what's your outlook here then in terms of the U.S. jobs outlook in the sense that is this cyclical or is it so structural in nature that we're going to be seeing these numbers that you just described for quite some time? And if that's the case, then what does the Fed do?
Well, the numbers are going to get worse. I mean, the jobs that we are creating, these phony jobs, are a function of all the cheap money and all the excess spending and borrowing that goes along with it. But now that the Fed has simply hinted about tapering, something it has no intention of doing, but the market is already starting to take away the punch bowl. Look at interest rates hitting now 2.7% on the 10-year. Mortgage rates are rising now closer to 5% here in the U.S. This is going to deflate the nascent housing bubble that the government has been trying to reflate. Americans can't afford these higher mortgage rates, and I think all the speculative buying that has come into the market in the past 6 months, they're going to be heading for the exits. Now that the secondary market for high-yielding investments is drying up on Wall Street, look what's happening to REITs, look what's happening to the home builders. Now also look at oil prices. Oil above $103 a barrel today. Gas prices are headed higher. Americans cannot afford higher mortgage rates, higher gasoline prices. Food prices are going up. Taxes are going up. Medical costs are going up. Insurance rates are going up. So I think the U.S. economy is headed right back into recession. These jobs are going to evaporate. The Fed is going to be forced to go for more QE. It's not the right thing to do, but it's the only thing the Fed knows how to do. So we're going to get more money printing, not less. And ultimately, that's very bad for the dollar, and it's going to be good for gold.
So, Peter, it's interesting. You just described a lot of the headwinds that are out there that perhaps still have yet to come in full force. Let's talk a little bit about the housing market as well, because I think you've got a different view, those housing stocks, and some would say that there has been a housing recovery. You don't think that's the case?
No, I think that the government has managed to blow some air back into a deflating bubble, but now that air is escaping. They're not going to succeed. The demand for new homes has come from speculators. It's because of record low mortgage rates that no longer exist. They're still low, but they're not low enough. And all the private equity guys and the hedge funds that were speculating, buying up all these single-family homes that are now sitting vacant. There's nobody living there. They really don't have any tenants. I think these properties are going to go back on the market. You also have a lot of banks that in the last few months have stepped up their foreclosures because they got optimistic that they might actually be able to sell a lot of these houses. So they're going to have houses coming on the market. And, you know, even the home builders, a lot of the new homes that they were building were being gobbled up right by speculators that had no intention of actually living in the houses that they were buying. Meantime, the actual buyer of homes, they're getting priced out of the market because prices have gone up. Mortgage rates have shot way up. Meanwhile, people are losing their full-time jobs. They've got part-time jobs. You can't afford a full-time mortgage with a part-time job.
Peter, I want to just dig into that a little bit more, because when you do hear some of these company managements from the home builders come out and talk about their outlooks, talk about their orders that are growing quite dramatically, double-digit territory, what's your take in terms of some of the CEO commentary? Because from their perspective, you would think that things are going quite well and that the individual buyer is, in fact, in the market.
Yeah, that's exactly what they were saying in 2005 and 6, 7, at the height of the housing bubble. They always have to talk their books. They're building these homes. They're not going to acknowledge that their business is about to evaporate. They want their stock price to go up. They might have some shares they're trying to unload themselves. So I wouldn't put any credibility into what these home building CEOs say. That's exactly what they said last time. The same thing as the realtors and the mortgage bankers. They're always talking about how good the economy is. They've got all these economists from realtors organizations. They're not economists, they're shills. They're PR guys. They're always going to talk about how great the housing market is, how sustainable it is. They're always going to try to rationalize a bubble. That's what they did before, and they're still doing it.
All right, so Peter, given that backdrop, tell us where you think that there are some opportunities. Where are you investing today? Where are you placing assets?
Well, there are a lot of opportunities because investors, I think, have got it wrong. They think the U.S. economy is recovering. It's not. They think inflation isn't a problem. It is. They think the Fed's about to tighten. They're not. So a lot of assets are mispriced. I think the dollar is overpriced. I think gold is way underpriced. I think gold stocks are dramatically underpriced. There's lots of opportunities. I think there's a lot of opportunities in the emerging markets. Stock markets there have been hammered recently. I think there's too much confidence and optimism in the U.S. economy, in the dollar, and in the Federal Reserve. I think it's all misplaced, and as a result, assets are mispriced. And the people who can see beneath the smoke screen and know what's really going on can take advantage of all the bargains that exist and avoid all the landmines that I think so many naive investors are stepping on.
So, Peter, let me ask you this as well then. The TSX, as I'm looking right now, it's underperforming the global markets, no doubt about it. It's down just over 2% for year-to-date performance versus double-digit territories. The Dow's up 15%. Would you be stepping into Canada right now?
Yeah, well, again, I like the resource sector. I'm very positive on the oil market. I mean, look at the price of oil, particularly now in terms of Canadian dollars, rising even faster than it is in terms of U.S. dollars. As I said earlier, I'm bullish long-term on the mining sector. There's a lot of big mining companies in Canada, obviously, getting hurt right now. But I do think that there's a lot more inflation in Canada than is generally perceived because Canada is following our misguided footsteps. Interest rates are too low. I think eventually the Canadians are going to be forced to start raising interest rates. That'll ultimately be positive for Canada because it'll mean a stronger Canadian dollar, which will be better for Canadian investments overall. But it's going to be negative for the U.S. as all these countries around the world that have been basically taking bullets for us, they've been deliberately undervaluing their currencies to try to prop up the dollar. This is going to come back to bite them in the form of higher inflation, which they're going to be forced to fight eventually with much tighter monetary policies. And I think that has big implications for the U.S. economy, for the dollar, and for commodity prices.
Peter, great to have you with us and your insight on a very interesting day in the marketplace, no doubt about it.
Yeah, thanks for having me.
Thank you. Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital, joining us from Connecticut.